Welcome back to the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your host, Ashley McVicker. And today we are tackling one of the most common questions we get at the bank, which is, what is a CD and should I open one?
Yeah, and we're breaking it all down today. So it depends on how much money you're working with, right? So whether it's $1,000 sitting in your savings or maybe it's $2 million sitting in the savings, we're going to share some strategies that are smart, simple, and what to do at each of these different money levels.
Yeah, so if you've never even heard of a CD before, we are going to be breaking all of it down and telling you what is the best way to use a CD. And while we are not financial advisors, we want to make that very clear on this episode. We do have some good advice regarding CDs, how to use them, and how much money you should put into them.
Yeah, so now that that's kind of out of the way, let's get on to what a CD is and how we can make your money work a little harder with a CD.
So a CD, Jill, is not, a disc like that you listen to music on.
Okay.
Because when I got to the bank, I knew you were. When I got to the bank and everyone was saying CD, I was like, okay, what the heck is going on? But it actually stands for Certificate of Deposit. And it is a type of savings account where you agree to leave your money in for a set amount of time and then you earn a set amount of interest. It's very simple, very secure, very safe.
Yeah, and it's kind of like guaranteed money, right? At the end of it.
It's guaranteed money. It's kind of like an investment account, but you're at a set percentage for a set amount of time. And then you can decide if you want to go back into it or not.
Got it. So for trading, maybe your flexibility, like for a checking account, this is a little less flexible, but there are more benefits to it, like that rate you talked about. So if you need your money out more quickly, I would say, then
if you need to spend it.
Yeah. If you need to spend your money, a CD might not be the best option for you, but we're talking about those who want to invest their money, don't want to dabble in the stock market, but this could be a great place to park your money for a time.
Yeah. And that's really what it is. You're parking your money for a set amount of time and you're not spending it.
Correct.
And the return is a higher interest than maybe you would get on a savings account or a checking account.
Gotcha.
And it's basically like us saying, thank you for letting us keep your money for a while.
So are there any risks to pulling your money out early?
So one of the risks is if you pull your money out early, you will be charged a penalty fee.
Okay.
And it doesn't mean you're going to be charged a penalty on your principal, which is the money that, so say I had $10,000, Jill, and I put that into a CD. That's my principal amount.
Okay.
But let's say I earned 4% or 5% on this. I could be penalized on that 4 or 5% that I've made up until the point that I've been wanting to take the money out.
Gotcha. So you get penalized. You might not get all of your interest.
Right. You just have to worry about the interest, not your principal.
And you might even have to pay some of that interest back that you've already accumulated if you pull the money out early. That's why it's super important to only put your money into a CD that if you know you don't need it.
Right. If you're ready to park it and set it aside for a while and you're not in a place where you need the cash.
Yeah.
So I think we should talk about different dollar amounts because everyone, has a different financial situation. And so I think it's interesting. And we've learned some different ways that you can kind of set up your CD to maybe make you the most interest or the most money, the best bang for your buck, if you will.
Yeah.
But if you're just starting out with maybe $1,000 to $10,000, that's a great starting point just to get your feet wet with a CD, I think.
Yeah, people shy away. They think they have to have thousands and thousands of dollars to put it in a CD, and that's just not the case. You can start with a lower amount of money. So $1,000 to $10,000, maybe even $5,000. If you save that much, that's so good. First of all, saving that amount of money, that's better than 40% of the United States, right? I think there's some statistic out there where half of our population can't even pay a $400 bill if they get
for an emergency. Yeah. And I think it's 80%.
Yeah, it's crazy.
So yeah, if you're already to the point where not only you're saving money, but you can put it somewhere where it's going to start earning you money. And I think that's a great thing too, that it shows people very, because I love the stock market. We talk about it all the time, but it's very volatile. The stock market is an investment platform. It's very volatile. It's not FDIC insured. No. It says it in big letters on any app that you're on. But, when you invest your money in a CD at a bank, your money's FDIC insured. Yep. So, that's another thing to consider too.
Right.
And it's just safe.
Yeah. Here's something to think about too is on that amount of money, you might already be making a lot of money in a checking account at your bank. And it might be very comparable to a CD. So before you open a CD with your $1,000 to $10,000 investment, check out your checking accounts. That gives you more flexibility, be able to spend it more often. For example, our Kasasa Cash account pays a high interest rate, which is almost equivalent to a lot of the CDs we offer right now. So up to that first $10,000, that checking account might be a good option for you. So make sure to compare that before you open a CD.
Absolutely. Okay, Jill, but I will say this. If you are somebody that is trying to save up money and you are getting a great percentage on your checking account, but you like to spend some of the cash, but you're like, I really want to save money, a CD is a great place to lock that up to make sure you're maybe not dipping into that cash.
Yeah,
But the checking account, I mean, you can do as literally many transactions as you want in a day.
Right.
We will let you, but you can't with a CD.
Correct.
You cannot do a transaction.
Yeah. So maybe if you are trying to save, this is going to be that little restriction that you need to pack more money away for a longer period of time.
Right.
Not touch it.
Right.
So kind of acts as a speed bump for that spending habit that you might have picked up somewhere. Yeah.
So usually when we are doing a CD from $1,000 to $10,000, any of those, we like to recommend from 6 to 12 months. So you'll earn more than you would typically with a basic savings account, and your money won't be tied up for too long. So it kind of just gives you a little taste of like, this is what it feels like. And honestly, there have been times in my life, I think about when I was building my house, I'm like, I wish I just would have had this in a CD, earning some more interest that I could have put more towards my house. In hindsight's always 20/20, Jill.
Right. Definitely. I love that you mentioned the 6 to 12 months. So a lot of people don't realize with a CD, you can pick different time periods to keep your money locked up. And we're going to talk about something in a little bit called CD laddering. So we'll explain it. It sounds really fancy, but it's actually super simple with how it works. Do you kind of want to talk about laddering and what that means?
Yeah. So let's say you have $5,000. Instead of putting all of that into one CD, you could take $2,500 and put that in a 6-month CD. And then you could take the other $2,500 and put that into a 12-month CD. They may have the same interest rate. They may have different interest rate, just depending on the market and what we think is going to happen. But that way, halfway through you putting your money away, you're able to take a draw and get your principal out while you still have the other money invested. So it's kind of like splitting something in half.
Yeah. So after that 6 months is up, that first $2,500 plus the interest is now available to you.
Right.
And you can maybe invest in another CD. If you need that money, you can go use it however you wanted to use it.
Absolutely. So if you were like, I lived without this, I got the interest, I want to put it back again, then you could do another 12-month CD. And then by the time that 6-month CD or that original 12-month CD is maturing, you take that interest. Now you only have 6 months left. And it's just like this really fun game. And it's called CD laddering.
I love it.
Yeah.
So that's kind of what we recommend doing with your first $10,000 if you're going to invest it in a CD. So maybe take a couple of different terms out, split your money, or put it all in one, and give it a try for your first $10,000.
Yeah, I think it's a great savings option for people. If anything, it's just a great savings option.
Yep.
Just holding your money, teaching you, we need to keep this back for emergencies, or maybe you have a purchase coming up in the near future. We both read Smart Women Finish Rich, and I love when he's talking about investments and like, well, why would I put it in a CD when I can put it in the market and it's going to earn me 10%? Well, you might get negative 10% in the market 1 year. So you really have to look at the things you're wanting to purchase or do with your money.
Right.
And if it's something that is coming up within a year or two and you want to have your principal amount, let's say it's $10,000 plus a little bit more, the best investment tool you could do is probably a CD. Because if you have something to pay for, you don't want to lose your money or be kind of in the hole.
Yeah, so definitely define your goals before you open a CD or do any investment.
Yes.
The next amount we're going to talk about is what if I have a $10,000 to $50,000 range? So it's a little bit more money. Maybe you got a bonus or a tax refund, or maybe you inherited some money. So now we've got a little bit more to work with, and that's a solid chunk. So anywhere $10,000 to $50,000 is a lot of money, but it opens up more options when it comes to CDs.
I definitely think it opens up more options to CD laddering too.
Yes.
So earlier we mentioned the $2,500 example with the 6 month and then the 12 month. But for something like this, I mean, you could do a 6 month, a 12 month, an 18 month, and a 24 month. And so you just constantly have this like revolving income, if you will, or like spurts of interest income that you get. And then you can just keep laddering them.
Got it. So instead of, let's kind of explain what that means. So like you have a 6 month CD, a 12 month, an 18 month, and a 24. So you take that whole $50,000 and you ladder it out to expire on those or mature at those times. Instead of locking that entire sum of money up for 2 whole years, which is, that 24-month term, you have some coming available every 6 months. So that gives you some more options. You're not locked up for a super long period of time.
Yeah, because $50,000 locked up for 2 years. I mean, let's just be real, Jill. A lot of people don't have that or can't do that. And they're thinking, why would I do that?
Right.
So it's like what you said, this money is becoming available 6 months, then another 6 months, then another 6 months, then another 6 months. It's available. But then you can also decide, I want to put it back into the market and just keep laddering that money.
Exactly. I think it just gives you some peace of mind and some consistency if you do it this way. If you have that amount of money, in 6 months, more money is going to become available. But it just gives you that little bit of time to make plans for that money when it is available.
Yeah, and I think that time goes by so fast with stuff like this. Like I said earlier, you're just like, I wish I would have done this with my money. I wish I would have put more into the market. I wish I would have had a CD. And so, yeah, I think sometimes like when your money's locked up, it feels like it's going to be forever, but
it goes by fast.
Gosh, half the time people don't even know they had a CD and it matured at the bank. We have to call people and say, what do you want to do with this? They're like, oh, I forgot I had it.
I think it's so funny how people do forget about that coming due. It's like, but if it's out of sight, out of mind, and that's what we want your savings to be, right? You would want it to be just something that's set aside for you. I want to talk about what it looks like. Say somebody had $30,000 that they want to invest in the CD. So you could put $10,000 in a 6 month CD, another $10,000 in a 12-month CD, and then the last $10,000 in an 18-month CD. So now you have CDs maturing every 6 months, like we've already talked about. It maybe when the first one comes due, you get a choice. Take the money out or roll it into a new CD, maybe a longer one that pays more. So longer term CDs pay more typically.
And here's something that people don't realize. So you don't have to take the interest out unless you want to, which is great. So most banks will either pay your interest out to you regularly, like on a monthly basis, or you can let the interest stay within the CD, which means you're earning interest on your interest.
That's so smart.
Yeah.
So instead of,
more money.
monthly taking out that money, it can be snowballing.
Yeah. And so hopefully when you're sitting down with someone that's opening the CD for you, they ask you these questions, but I mean, that's a really good thing to make sure, are you going to give this to me monthly or can I leave this interest in there and let it snowball?
Yeah. Make sure you ask that question. That's great. So from $10,000 to $50,000, think about laddering your CDs. Maybe think about what you want to do with your interest. Maybe you want to keep it in there longer and let it accumulate.
Okay. So maybe now you are in an even higher bracket of a CD. So you've got $50,000 to $100,000, and there's definitely some more options you could do with that money. So maybe you sold your home and made some money, or you sold a business and made some money, or you've just been sitting on a stockpile of cash and you're like, I should probably do something to earn myself some money. The biggest question is, should I go with a CD or should I leave it in a high yield savings account?
Yeah. And that's such a great question because both are low risk. We learned that CDs are really low risk. We know what we're getting out of it, but savings accounts are low risk too. And there are some pretty great savings account options out there that do give you a high yield of return, right? Yeah. So just to go back to what a savings or checking account can do, it gives you a little more flexibility. So you can take that money out and do what you want. And the interest rates, again, are super competitive. But here's the trade-off. The interest rate on a high yield savings account can change at any time, so they're not guaranteed. But with a CD, they're guaranteed. You know that that's what you're getting at the end of the day.
Yeah, like, if I do a 6-month CD for 5% interest, I'm getting that 5% interest.
Yes.
But if the bank decided we want to lower our interest rate on the savings account, I mean, you just have no say.
Right.
They're just going to lower it.
It's written on every single checking and savings account that the bank has the authority to change those at any time. So you just want to make sure that you're knowing and you know exactly what your goal is with that money.
And I just want to reiterate with like a 5% on a huge CD for 18 months, like that's a lot of interest and that's a solid percentage.
Yeah.
Whereas you don't know what the stock market may do in 2 years. I mean, think about COVID, like it literally bottomed out. And so just once again, this is a great place for like very secure funds, low risk, lower reward, but still a reward.
Right. I always think about, people that are reaching their retirement age and they can start pulling some of their money out of their 401ks or whatever. CDs are a great option for you because there's that less risk of losing that money. So say you're retiring right now and you can't afford to lose that money for the next 5 years and hope the stock market comes back. Well, in a CD, if you're guaranteed 5% of an interest rate, that's a great option for you. And you can, again, ladder that for the 6 months, you'll have money come available, 12 months, and then again later on. So if you're in that situation, you have this amount of money, this is a great option for you.
Yeah. And I forgot to mention this, but typically over $50,000 or more, you may qualify for a jumbo CD rate.
Yeah. People don't realize that.
Which just means you have more money, like we're willing to give you a little bit more money to house your money.
Exactly. I like to run through scenarios. I work with numbers. So let's talk about another situation. So say you have $85,000. You're in this price or this income range or savings range. You have $85,000 that you want to invest. Say you take the first $25,000, you put it in a 1-year CD, so a 12-month CD. You take the second $25,000 and you can put it in an 18-month CD. Well, then you take the third $25,000 and you can put it in a 2-year CD. So it's a little further out there, but say you do want to keep some of that money yourself. Well, you could put that remaining $10,000 in a high yield savings account, which is really great. You'll have flexibility on that $10,000 to do what you need to pay your bills, or if something comes up, you'll still have that little bit of cash that's not tied up. So there are flexible ways. You don't have to put the whole thing in a CD. You can have options here.
That's the thing I don't think people realize with their money. Like, you do not have to, just because you have $30,000, you don't have to put all the $30,000 into one option. I mean, you can separate, cut this pie how you want to cut the pie.
Yeah.
Do what you want to do and what will work best for you.
So if you're in that range, 50 to 100, some great options for you. A money market or high yield savings account paired with some CD laddering is a great way to park your money.
A great way just to make a little extra interest income too.
Exactly.
I know some people, they've gotten to this next point that we're talking to where they have $100,000 to $250,000 in a CD and they ladder it and it's helping them like live.
Yes.
That's why I don't think people can get to this point in their life. I'm like, that is nice.
Yeah. So if you've built up your money, maybe you've done CD laddering for 10 years and now you've accumulated a bunch more money. You're in that high range where $100,000 to $250,000. And you've just been saving diligently. And now it's, how do I protect this money? And this is really interesting because we get into the $250,000 FDIC insurance level. We're going to talk a lot about this. And we have an entire episode about this. People don't realize that when you get to that level, you can actually get more coverage for that FDIC insurance at your bank than just taking that $250,000 at face value.
Right. So the $250,000 for FDIC insurance for a bank is the standard coverage limit for deposits at any one bank. Yes. So at this $250,000 mark, this is when you need to be thinking about, and I mentioned this earlier, FDIC insurance. And so we only insure up to $250,000 on a deposit with a single person. And a lot of people don't realize that we can structure things to make sure if you have over that amount that you are covered.
Yeah. So I love to stop and talk about account ownership because Like I said, we have another episode all about ownership, but I kind of want to run through it just really briefly today and talk about how you can structure your CDs even. So you can do your checking account to be insured like this, but you can also do CDs in different ownership structures to make sure that you're covered. So what does different ownership actually mean, Ashley, when it comes to a CD?
So basically ownership just means whose name is on the account. It's as easy as that.
Yeah. Let's walk through some common types of ownership. So you have the individual CD. So this is a CD that is strictly in your name. The FDIC covers you up to $250,000 in this type of account.
Yeah. So you're in the clear. If anything happened to the bank, just know you're going to get your $250,000 back.
Right.
So the second one is going to be a joint CD. So this account is in your name and someone else's name. It's typically like a spouse or family member of some sort. I sometimes, think about maybe a parent and a child. They're trying, when your kid gets like birthday money.
Yeah.
Well, perfect place. We'll put it in a CD for the kid. So,
right.
But each person is insured up to $250,000 automatically. So right then and there, you're already insured up to $500,000 just by having two people's names on the account, being owners essentially.
Yep. So that's the joint account structure.
Joint account structure.
Okay. So the next structure for a CD is a payable upon death CD. So a POD CD. So this is a CD where you name one or more beneficiaries. And we talk a lot about beneficiaries on this podcast, but the FDIC adds $250,000 of insurance for each beneficiary you list on your CD. So one account could be insured up to $1 million or more, depending on how many people you name as beneficiaries. So if you are, say, Jill has 4 children and I put each of them on my CD as beneficiaries. So I have 250 times 1, 2, 3, 5. So that, I get
1.25 million.
Yeah.
I'm not saying that right, but
that means I'm insured for a lot more than just that 250 amount.
The next one is a trust CD. So this is a CD opened in the name of a trust. So like a family or a living trust. The coverage depends on how many beneficiaries are listed and how the trust is structured. And it's great for estate planning or long-term protection. So ask your banker if this is right for you, or I would ask your attorney. Definitely. Yeah. Evan Taylor probably has a lot to say about this one.
Yes, for sure. So another CD type is the IRA CD, so individual retirement account CD. So a CD that lives inside your retirement account is what this is, which is interesting. So the money is still FDIC insured up to $250,000 for a retirement account specifically. It's good for people who've rolled over their 401ks or want steady, low risk retirement growth. So we talked about that already just a little bit, but this is that type of CD. So you want an IRA CD if you want to really ladder your 401k income.
So I think the big takeaway here is that we want people to understand FDIC insurance, that you don't have to cap your CD out at $250,000 just because that's what the limit is for a single individual. You can put ownerships or beneficiaries on the account. It automatically insures that up to however many are on the account.
Exactly.
So there's just things to be thinking of when you're going to get a CD.
Yeah. And you don't have to spread your money out. And I think it's so funny when people, they're like, I need to diversify.
Yeah.
And they think that diversifying is by opening different CDs and laddering them with separate banks. But really, you can keep all your money at one place and just structure it differently so you can have more.
And we will help you do that.
Yes, for sure. Let's go back to that $100,000 to $250,000 level that we're talking about. And these are some questions that you can ask yourself before you start structuring your CDs, so you make sure that you're aligned with your money goals. So the first one is start by deciding what money you might need access to within the next year. The next thing you're going to do is divide the rest across a few longer term CDs to lock in better rates. The third thing you're going to do is use that multiple ownership type of accounts if you need to make sure you're covered for FDIC insurance. So joint, trust, IRA CDs, there's all those options for you. And then the last thing you're going to say is don't forget to add beneficiaries for added protection there.
Don't forget to add beneficiaries on literally anything in your life, people.
Yes.
It's my hot take.
Definitely.
So we love examples. We're going to use a guy named Mark. Let's say Mark has $180,000 sitting in his savings account after selling a rental home. Hey, good for you. He decided to break it up like this. He did $50,000 in a 12-month CD for short-term access. He did $50,000 in a 24-month CD with a higher rate, but it's locked up for 2 years. $50,000 in a 36-month CD. And he kept $30,000 in a high-yield savings account for flexibility. So there you go. Easy way to structure your money if you're someone like that has $180,000 on hand.
Yeah.
Which people do.
Well, it's the truth. And here's the smart part about this example is he opens each CD as a payable upon death account and names his spouse and 2 adult children as beneficiaries. So that one move gives him up to $750,000 in protection on FDIC insurance across all of his accounts. So if he had saved up more, he's still protected up to that $750,000.
Right. So not only is he protected, but he's also earning more money in the savings, and he's spaced it out in a way that gives him some income every year, every so often.
For sure. So if you're anywhere near that 250 mark or that level, it's time to talk with your banker, really, because I wouldn't have known to do this well, I'm not at this level, but I wouldn't know what to do with that amount of money. But they'll help you check your FDIC insurance coverage. They'll take you through the calculations. They'll add and update your beneficiaries for you if you need to do that. And they'll build you a CD ladder that really works for you.
Mm-hmm. Yeah, you don't have to be a financial expert. We will help you with all of it.
Yeah. Sometimes I feel like we get overwhelmed and think that we have to make all the decisions ourselves when really that's why your bank is there, is they're there to give you advice for that kind of thing.
Okay, so now let's talk about $250,000 and beyond. So you're definitely at a different level at this point, and you've got more in cash. So this kind of money gives you some more options, but it also means you've got to be more thoughtful about how you protect it and structure it.
Yeah, I mean, you're over the FDIC insurance limit for a single account. So the big question comes into play is, how do I keep it all insured and working for me at this level?
So we've already talked about using different ownership types like joint accounts, trust CDs, and naming beneficiaries to increase your coverage. But there's another great option specifically for CDs that you might not know about, and it's called CDARS.
Yeah, so CDARS is a great option. It stands for Certificate of Deposit Account Registry Service. So it allows you to place a large amount of money into CDs, let's say $500,000 or up to $2 million, and still keep every dollar FDIC insured.
Yes. So here's how it works. Your bank, like us, partner with other banks, and behind the scenes, we split your large deposits into smaller chunks and place them at different banks within the network. So each piece stays under the FDIC insurance limit. But to you, it feels like one CD, but it's all protected.
Yeah. And I love how this works because everything's in the same place. So you get one rate, one bank statement, one bank relationship, and your whole balance is insured up to that $2 million if you have it.
Yeah, it's completely safe. And CDARS has been around for a really long time.
Yes. And a lot of banks around here participate in it.
Yeah.
So,
and it's an acronym, CDARS.
Yeah.
It's not, however you spell the CDARS.
Right. So how do you structure that amount of money? I mean, that's a huge level. Let's say $400,000 you have and you want to use this CDARS. Let's talk about what a smart structure looks like for this. So $50,000 could go into a 6-month CD with your name on it. Another 50 could go into a 12-month joint CD with your spouse. Another 50 could go into a 24-month POD CD with your children listed as beneficiaries, and $250,000 could be placed in a CDARS account as a longer term CD to keep it insured and locked in at a great rate.
Yeah, so this structure gives you access to some money sooner, higher rates on longer terms, and full FDIC coverage.
Yeah, so don't worry about taking your money a million different places.
Yeah,
We
you
do
can
it
keep
for
it
you.
all at one bank, and it's all FDIC insured. It also gives you a mix of flexibility and some discipline. So
Yeah.
I'd imagine if someone has $250,000, they're probably pretty good with their finances, in my opinion.
Yes.
But it's still, if you're someone that's like, well, now I have all this money, I want to spend it, but you're saving for more of a longer term goal, this still gives you that discipline, but gives you access to your funds when you need them.
Yeah. So what do you ask your banker if CDARS is something you want to look into when you're sitting on $250K or more?
So I'm so glad you asked, because I have the questions, Jill.
Okay.
So first question I would ask is, can I use CDARS to keep this fully insured?
Mm-hmm.
The second is, what mix of CD terms makes sense for my goals? The third is, should I title accounts individually, jointly, or with beneficiaries? And what will my ladder look like over time?
Exactly. So your banker is going to help you create a long-term plan that protects every dollar and earns you that competitive interest rate. And it keeps the paperwork and maintenance kind of to a minimum.
Yeah. So if you've been holding on to a large sum of money and you're unsure what to do with it, come and see us, because we can help you plan it out and make sure everything is insured and giving you the best bang for your buck, while also making sure you have that flexibility if you need the money.
Yeah. So the main takeaway out of this entire episode is, whether you have $1,000 saved up or $2 million saved up in an account, there's a smart way to structure CDs, and they're a great option for you if you're looking to put your money somewhere, and at any level. So you could, it's not just about picking the highest rate. It's about understanding your timeline, your savings goals, and your insurance coverage as well with each bank.
Absolutely.
Yeah.
I think it's a great option for people if they're all of the things you said. So
So if you are interested in opening a CD or just sitting down with a banker, our personal bankers would love to sit and talk to you. Our customer service reps know all about all these options we discussed today. And I know they would be happy to hear from any of our listeners. So
Yes, Jill. So like you said, anybody that wants to get a CD, they can go to our website, myfsb.com, or stop by any of our branches, and our people would love to help you jump into the world of CDs. So thank you so much for listening, and we will see you next week. So Jill, where do we go from here?
be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.